Picture this. One company quietly holds the deed to your retirement, your neighbor's 401k, and half the planet's ETFs. That's Blackrock. $10 trillion under one roof. Now imagine Dave Ramsey storming in with a pair of scissors labeled debt-free, ready to shred the place. Who's right? Stick around. By the end you'll know exactly where to park your next dollar. Blackrock just crossed the 10 trillion line, more money than Germany and France make in a year. Ramsey's response? Cool story bro, but they still can't beat a paid-off mortgage and a no-load growth fund. Boom, fight night. Blackrock doesn't pick hot stocks, it owns the stadium. Through iShares ETFs, they skim 3 basis point fees on everything from Brazilian water utilities to AAA treasuries. Their algos read Fed statements faster than you scroll TikTok, shifting bond allocations before you've poured your coffee. 10 trillion means when they sneeze, markets catch pneumonia. Here's the twist. They don't gamble with their own cash. They babysit yours, smoothing bumps while clipping micro fees a million times a second. It's volume, not heroics, and it's unbeatable unless you ask Dave Ramsey. His first commandment, thou shalt not invest until thy MasterCard is ashes. Baby step 1, grand in the bank for emergencies. Baby step 2, debt snowball until every balance hits 0. Only then does he crack open the mutual fund door, and only growth stock funds. Bonds? Bonds are for people who like mediocrity, he growls. 4 buckets, growth and income, aggressive growth, international, each 25%, ride them for 30 years. No timing, no crypto, no 60-40th split. The math is wild. 100% equities averages 10-11% a year, bonds drag that to 8. Ramsey banks on the gap, trusting your patience to outrun recessions. So who survives a real retirement? Picture a 45-year-old with $200K. Blackrock's target date fund glides from 90% stocks to 50% by age 65, cushioning sequence of returns risk. Ramsey stays 100% stocks, so a 2008-style 50% drop hacks the nest egg to $100K overnight. Ramsey's comeback? Yeah, but it bounced back in 4 years. True, if you don't bail. Problem, 60% of real humans sell at the bottom. Blackrock's bond pillow softens the panic, but it also trims long-term gains by roughly 2 points a year. Over 30 years, that tiny 2-point gap compounds to almost half the account. Translation, safety costs money. Ramsey hates fees the way cats hate baths. A typical actively managed growth fund he likes might charge 0.65%. BlackRock's core ETFs charge 0.03%. Sounds like Ramsey loses, except he wants you with a SmartVestor Pro who may skim another 1%. BlackRock's fee stays microscopic, but you still need a platform to buy ETFs, and platforms want their cut. Net result, both paths can land near 1% if you're not eagle-eyed. The real difference is control. Ramsey wants you locked on one number, the mortgage balance. BlackRock wants you chill about every number, inflation break-evens, yield curve inversion, the works. Ask yourself, stick shift sports car or autonomous Tesla? Stick gives you Ramsey. Every gear change you make, every swerve you survive, the thrill is yours, but so is the ditch. BlackRock's Tesla keeps you in lane, slows before the curve, quietly maps the route. Neither is wrong. They answer different stomach acid levels. If debt makes you nauseous, Ramsey wins. If market volatility steals your sleep, BlackRock's glide path wins. Smash subscribe if you want the no-fluff comparison I just ran between Ramsey's 4-fund recipe and a zero-fee 3-fund ETF portfolio. Comment debt-free or diversify below. Tell me which camp owns your heart. BlackRock can't force you to stay invested. Ramsey can't force the market to play nice. Dominance, then, isn't about assets under management. It's about behavior under stress. 10 trillion on autopilot still crashes if investors yank the plug. Meanwhile, a debt-free Ramsey devotee with $100K and iron discipline can outpace Wall Street's fee machine just by staying the course. So who dominates? Whoever you actually become. Build the emergency fund, nuke the plastic, then pick the strategy you'll stick with when the headlines scream apocalypse. That's the smartest way to build wealth. BlackRock owns the world's ticker tape. Ramsey owns your alarm clock. One keeps markets humming, the other keeps you honest. Combine the best, nuke debt like Ramsey, diversify costs like BlackRock, and you'll write a script neither giant could author alone. Your own paid-for future.